So here in the last class, we focused and discussed in detail the exam focus areas, the focus of your, uh, what are the common mistakes basically that students commit, candidates commit in answering business risk questions and in answering their Rome related questions. There are certain common errors that students commit in terms of exam scenario, in terms of exam questions. Now, in today's class, we will learn a very important concept. That is the key to passing the paper, right? How to answer exam standard questions. You will get risk assessment in more or less every exam. So because it is such an important area and such a favorite area of the examiner, that I've produced for you people, I've produced a step-by-step guide, like a fill in the blanks approach to solving the risk assessment questions, to attempting the risk assessment questions. Now that step-by-step approach actually helps to understand concepts, and you can sort of relate to those. Paper solving actually becomes easy. So let's see if it actually becomes easy or not. Now you have this past exam question excerpt. This is a past exam question excerpt that I've taken, and we will see how to write business risks, how to write Rome or audit risks. Delico was established 20 years ago and has become known as a leading supplier of machinery used in the coring industry, with its customers operating quarries which extract stone used mainly for construction. So Delico is engaged in, it's a supplier of machinery. Remember, Delico, when we talk about Delico, it is a leading supplier of machinery, right? Which is used in the industry. Machines and equipments made by Delico are mostly made to order. They are made to order in the company's 3 manufacturing sites. Customers approach Delico to design and develop a machine or piece of equipment specific to their needs. So we can understand, you can appreciate that these are tailor-made machines according to the specific needs of the customers. Where management considers that the design work will be significant, the customer is required to pay a 30% payment in advance. So where design work will be significant, you have to make 30% advance payment, which is used to fund the design work. The remaining 70% is paid on delivery of the machine to the customer. Typically, a machine takes 3 months to build, and a smaller piece of equipment takes on average 6 weeks. The design and manufacture of bespoke machinery involving payments in advance has increased during the year. So it means though which machines which take 3 months to build, because it means the design work will be significant. Delico also manufactures a range of generic products which are offered for sale to all customers, including drills, conveyors, and crushing equipment. So this is the scenario that you've been given. You were given actually in a past exam question. So this is exactly an exam standard question. Now, the point that you need to understand when answering this question is, first, let's see how to tackle business risk. If you were asked to evaluate business risk in this scenario, what would be the first step? The first step is to identify the relevant issue from the scenario, the relevant business risk from the scenario. You just have to copy paste the relevant issue, literally copy paste. The company manufactures bespoke machines for clients which may take 6 months to complete, right? So this is basically one thing that you need to understand. Now, step 2 is implications of the issue. This is very important. You need to understand the implications of the issue. That why is this a problem? During this time, the company has funds tied up in work in progress. Now, why is that a problem? Because this would lead to cash flow problems. The 30% deposit, initial deposit or advance, that may not cover all the upfront costs. So with that in perspective, a lot of companies' funds would remain tied up in that work in progress, in that inventory, and that would create cash flow difficulties for the business, right? That would create cash flow difficulties for the business. And so now step 2A, assessment or criticality of the issue. Remember, we talked about if at all, where possible, where possible. This may not be possible in all scenarios, in all questions, but where possible, because you have been told in the scenario that the design and manufacture of bespoke machinery involving payments in advance has increased during the year. So this service has increased in the year, putting further strains on cash flow. So this is going to be a cause of grave concern for the business for the reason that this particular service has increased during the year. So this factor exaggerates the intensity or gravity of the issue. So you see, what is the first step? To just copy paste the relevant issue from the scenario. You copy pasted that bespoke machines are manufactured which are time consuming to build. Step 2 is the most important. What are the implications of this? So the highlighted portion actually tells you funds being tied up in work in progress, cash flow difficulties, because the initial deposit, the initial advance may not cover all the upfront costs. So these are the implications. These are the troubles for the business. These are the troubles or difficulties for the business. Remember, when you're talking about business risks, when you're talking about businesses, you will be talking about difficulties for the business, not for the auditor, not for anyone else, but for the business. That how is that or why is that an issue for the business? Because funds are getting tied up in work in progress, and so cash flow difficulties are likely to arise out of this. Proceed. Now the second area that you need to learn in this class is Rome, the risk of material misstatement. That could be another area which you could be examined on. So basically, obviously, it is related to revenue recognition, to revenues. Now, what is the first step in this? Step 1 would always be, again, to identify the relevant issue from the scenario. That is, to copy paste the relevant issue from the scenario. Now, what is the relevant issue in this case? That the company is receiving, you have been told in the scenario that company receives a 30% deposit for the design of bespoke machinery, where the design work is significant. A 30% advance is obtained. So step 1 is to just identify the relevant issue from the scenario, to just copy paste the relevant issue from the scenario. What is step 2? Step 2 is to calculate and conclude on the materiality of the issue. This is a very, very important point that you need to take care of. You don't have to just calculate materiality, but you also have to conclude on that materiality. Now, what do we mean by calculation of materiality and what do we mean by conclusion of materiality? Let's see that. Calculation, when we talk about the calculation or computation of materiality levels, remember that is based on some benchmarks like profit before tax, total assets. So most of the examination questions that you would find in your question papers, you would see over there that they are either based, you will always be given draft profit before tax, or you could be given total assets, right? You would be given in most questions draft profit before tax, total assets. So you will have to calculate materiality with of that particular transaction or of a misstatement with reference to that PBT with reference to total assets. Certain rule of thumbs you need to keep in mind. If the percentage that you have calculated exceeds 5% in case of PBT, then 5% or more is used as a rule of thumb to be material. Likewise, if the percentage that you've calculated for assets, that is zero point 0.5 in the range of 0.5 to 1% or more, then that is considered to be material, right? So you need to see and understand the calculation of materiality. Secondly, you also need to keep in mind that you have to conclude on materiality. That is, you have to say that this particular item is material to both the statement of comprehensive income and statement of financial position, or this is material to statement of comprehensive income but not statement of financial position. So overall it is material. It is possible that a particular material misstatement is only material to one of these statements, but even if it is material to one of these statements and not both, it would still be construed or treated as material. I would also like to give you a top tip over here, and that is related to the fact that you have to compute materiality with respect to all benchmarks. I think we also discussed this earlier with respect to all benchmarks. For example, if there is an impairment issue, let's say there's an impairment issue. If at all there is an impairment issue, you should appreciate that it would impact PPE as well as impairment loss. It will impact PPE as well as impairment loss. So impairment loss is an item of profit or loss account, and so you would have to calculate materiality with reference to PBT, while PPE is an item of uh, statement of financial position, so you would have to calculate materiality with reference to total assets. So remember that you have to calculate materiality with respect to all benchmarks, and then you also have to conclude on that materiality. You need to give a conclusion that okay, this is this particular thing is material to the statement of comprehensive income, but not to statement of financial position, so overall material, or this is material to both the statement of comprehensive income and statement of financial position. So I hope this step 2 is clear. Now, what is the step 3 that you need to keep in mind? You should be able to state the relevant financial reporting principles. You should be able to state the relevant financial reporting principles. Now, in this particular scenario, what is the relevant financial reporting principle? The relevant financial reporting principle would come from IFRS 15. There are no marks for identifying the title of the accounting standard, the number of the accounting standard. But to be honest with you, it gives a very good impression to the examiner if you're mentioning, there has a psychological impact to it, that if you're mentioning the accounting standard, that gives an indication to the examiner that okay, fine, the candidate seems to be well prepared. It does gives that indication that the candidate seems to be quite well prepared in that particular topic. So what is the relevant principle for this 30% advance? Revenue should be recognized over time or at a point in time when control is passed, right? This is the IFRS principle, which is now such points, whether revenue is to be recognized over time or at a point in time, that is basically determined by the contractual terms. What does the contract says? If the contract says that if a customer cancels contract in between, what are the terms, etc., etc. So it depends on when control is passed, depends on the contractual terms. But obviously, payments received in advance of control passing, when you haven't, when the company hasn't transferred the machinery to the customer, the payments that are that 30% deposit, which is advance, that should be recognized as deferred income, because performance obligation, to be honest, hasn't been discharged at that time. I'm taking an advance from you. I have not even started working on the design. Has the performance obligation been discharged? The answer is no. The performance obligation has not been discharged. The performance obligation, for example, in this case is most likely to be that you deliver the machinery to the customer. That should be the performance obligation, most likely performance obligation in this case. So if you, even if you've received cash in advance, you cannot recognize it as your revenue. Rather, you would park it in as deferred income or unearned income. Unearned income or deferred income is cash that you've received in advance for performance obligations which have not yet been discharged. So as IFRS 15 says that recognize revenue as and when performance obligation is satisfied. So because at the time you've received advance, you haven't satisfied the performance obligation of delivering the equipment to the customer, you cannot recognize your revenue. Okay, now what is the fourth step? That is to link the risk in the scenario to step 3. What could be the risk? The risk could be that revenue might be recognized early when payment is received. That is, you recognize revenue on receipt basis, which is totally in contravention of IFRS principles. IFRS always requires the matching concept, and so that would require that revenue, the risk is that revenue might be recognized early, that is at the time the payment is received, when no performance obligations in effect have been satisfied. So you need to make sure that revenue recognition is not accelerated. Acceleration of revenue recognition is something that has to be avoided, but there is a risk that it has been done. Now, between step 4 and step 5, for Rome at assertion level, remember, between step 4 and step 5, remember this is an exam technique for Rome at assertion level. Rome at FS level are dealt with differently, right? We're talking about Rome at assertion level. So between step 4 and step 5, there's a hidden step that might be a nightmare for many candidates, but that's how it is. Between step 4 and step 5, remember double entry. Double entry. That's not a favorite area of most students, but it is important to know the double entry. Now, what is the double entry for this 30% deposit? When you receive this advance, what double entry should be processed? So the correct double entry is what? You debit your bank and you credit your deferred income, which is a liability. So on one hand, you would have this money in your bank, and on the other hand, you would recognize it as unearned income or as a deferred income. Okay, very good. Now, what was the risk? What was the risk? The risk was that revenue might be early recognized. That means, let's now move on to step 5. Illustrate the impact of the risk on financial statements. Illustrate the impact of the risk on financial statements. So what would be the risk? This may result in an overstatement of revenue. If you recognize revenue early, your revenue would be overstated and your liabilities would be understated. Your deferred income, which is a liability, would be understated for deferred revenue. Because what would happen? The mistake that could occur, is that revenue is early recorded. So what would be the double entry in that case if the erroneous entry is processed? Debit bank, credit revenue, which would be incorrect. So you've recognized some revenue which should not have been recognized. So your revenue is overstated. Your revenue is overstated. You have recognized revenue which has not even occurred. So your revenue is overstated. And you fail to recognize this liability. You fail to recognize this liability, deferred income liability. You did not recognize it. So if you haven't recognized the liability, that liability is understated. So I hope you're clear on the application of these 5 steps. The first step, to copy the relevant issue from the scenario. Second step, to calculate and conclude on materiality. In this particular scenario, because there was not enough information available, so we did not conclude on this issue. Step 3, to state the relevant financial reporting principles. Now you see, IFRS 15 has got a host of principles, but we only talked about the principle regarding the timing of revenue recognition, whether revenue should be recognized over time or at a point in time. So then step 4, what is step 4? Step 4 is that revenue might be early recognized, acceleration in revenue recognition, rather than being deferred. Rather than deferring revenue recognition, you early recognize it. Step 5, you illustrate the impact of risk on financial statements, which may result in an overstatement of revenue and an understatement of liabilities for deferred revenue. So the next risk that we would now see is ROM in inventory valuation. ROM in inventory valuation. Like we talked about ROM in the revenue recognition, now we will talk about ROM in inventory valuation, because there's a lot of work in progress. So step 1, again the same step would be repeated. Identify, copy paste the relevant issue from the scenario. Company manufactures machines over a period of up to 3 months, which gives rise to work in progress. Step 2, calculate and conclude on materiality of the issue. No information has been given, so step 2 will be neglected, will be ignored. Step 3, state the relevant financial reporting principles. Now, what are the relevant financial reporting principles? Valuation of inventories at the lower of cost and net realizable value, where cost includes all the costs of purchase and conversion. Cost of conversion includes the labor, direct labor cost, and the overhead cost, include production overheads only, including overheads of getting the item to its present location and condition. This is the simple concept of inventory valuation as per IS 2. Step 4, Link the risk in the scenario to step 3. There is a risk that an order for bespoke machinery is cancelled. And the inventory NRV falls below the net costs incurred. Order cancellation is a normal business world phenomenon. So in that case, the net realizable value of the inventory will fall below the costs incurred, because what is the estimated selling proceeds? In some cases nil, except for that 30% which you may consider as non-refundable. If that's non-refundable, then you have estimated selling price of that inventory is potentially 0, because you may not be able to sell it to any other customer because of its bespoke nature, while the cost would be higher. Cost of the inventory would be higher because maybe you must have invested some money in the material, some labor work might have been done. So in that case, your cost is high, your NRV is low. So inventory valuation is lower of cost and net realizable value. Now between step 4 and step 5, again, there comes in that step, which is the double entry. How do we record inventory? We debit inventory and we credit cost of sales. We debit inventory and we credit cost of sales. So this is the recording mechanism for recording of inventories. Now what would happen? Step 5, illustrate the impact of the risk on financial statements. So you see, you're specifying that this would lead to overstatement of inventory. You're specifically saying that this would lead to overstatement of inventory, because if you haven't written down the inventory to the lower of cost and net realizable value, then it is a pay. If cost is say 100 and NRV is 50, inventory is appearing in the financial statements at a value of 100, while it should be in reality, as per IFRS, it should appear at 50. So I think it is very easy to understand that inventory is overstated. And always remember, closing inventory is inversely related to cost of sales. The higher the closing inventory, the lower would be the cost of sales. The lower the closing inventory, the higher would be the cost of sales. So if inventory is overstated, cost of sales would be understated. And understatement of cost of sales means overstatement of profit. Remember, we focused a lot on direction of misstatement. So you see, in step 5, in both the examples that we've discussed so far, in step 5, we talked about which component of the financial statement would be overstated, which component of the financial statement would be understated. In the first example, Roman revenue recognition, as well as in the second example, Roman inventory valuation, we've talked about which components of the financial statements would be over or understated. So